Hello, YouTube. We are looking at a pattern we've only seen 5 times in 150 years in the 1890s, in the 1930s, 1960s, and 70s, and now in 2022. So, one more time, this pattern has only been seen 5 times in 150 years. Oh, my goodness. And looking to our other chart we've been looking at for a while, the 60/40 portfolio was at its worst year to date return in the past 100 years. This is going to be one for the history books. And as we're looking here, we're looking specifically at this pattern, which is a bearish engulfing pattern, which means that we form a higher high and a lower low. And that is how we form the bearish engulfing candle. So there's a lot for us to go through this weekend. And I would really appreciate if you could smash that thumbs up to show me some support. Please and thank you. Happy holidays. Let's get started. All right, so this bearish engulfing candle is pretty simple, and we're going to look at the definition in a moment. But at a high level, I just want to tease out what I'm looking at here. So 1, 2, 3, 4, 5. And I have some notes prepared, but right now I'm going to walk you through what if green, what if red. So the word started in 100 years, which means that our frame of reference or our recency bias is going to be a little bit skewed because if you're not at least 100 years old, you've never experienced declines this bad. And also, if you're not at least at least 50 years old, you've not experienced the moves that happened in the 1970s and 60s, and let alone what happened in the 1930s. Why? Well, I have not been trading I started trading in about 2006, 2007, and all that means is that my frame of reference is right here, or my recency bias is that if we go down, we just go straight back up. And I think a lot of people who are watching these videos might be in that same time frame. So what I'm trying to do is to understand the other part of the puzzle, meaning the rest of the chart, which is a lot more time than the small fraction I've been trading. So if history tells us that when this pattern plays out, we have to be mindful of it, I'm not going to ignore it. And I cannot say that I understand or have experienced this type of trading because this is for the history books. 5 times in 150 years, or the worst start in 100 years. So there's a lot that we can glean from this, but there's also a lot that we're not going to have as for certain, which means we're going to be looking back in hindsight as the next candles form and say, oh, I understand now. But right now, there's a lot of things we can be certain about, but there's also a lot we are not going to be certain about. Let's jump in now. So the first part is that if we're going to be going green on the year, I'm actually going to jump to my notes here. So I've got a bullish scenario, which means that 3 out of 4 times we actually close the next year green. So there's your bull case at a high level. And we required at least a back test of the third candle top. We've not done that yet. We got to get down to 3247 on SPX for that to happen. And if we close red on the year, that's where we get the nasty drop. That's the 1973 drop, I believe. So that's all we're looking for. The seasonality chart tells us that if we're able to, again, right now we're not really talking about the last 2 weeks of the year. We're trying to give you a little bit of a roadmap as a follow-up to last weekend's video where I laid out the trap video. So when we look here to our seasonality chart, I don't know if we're going to get this move higher. I'm less concerned about the small move. I'm really concerned about the entirety of the year of 2023. So what I do know is that whatever happens into January is less important than how we start out 2023. And I'm specifically focused on this part right here, January to April. Why? Well, normally the market doesn't do very much. It goes sideways, up and down, but holds roughly green. So if we're going to repeat 2008, we're not going to be green. If we're going to get that green candle or get 4 out of 5 now in hindsight that are now green, all we have to really pay attention to is that when we open 2023, that we remain green. We get small dips, they get bought up, small dips, bought up, small dips, bought up, and that we're higher into the end of Q1 or basically April. So that's the bullish scenario that we're looking for a bottom to get carved out into the first 3 months of the year. That would be the soft landing. We repeat the cycle of 3 out of 4 and go to 4 out of 5 green, and that's it. We don't have to backtest 3247. We got down to roughly 3,500. Maybe that's close enough. But if it's not, let's make sure we understand the other side, the bearish scenario. And thank you to Braxy, who's made this very easy to follow. We've been tracking this with a candlestick pattern, but this line chart tells the story very simply, right? You get the story in a second. Oh my goodness. This is the part where it just starts going straight down. So if we're going to repeat the one time where we went down in 1973, 74, well, it gets dramatically worse. It's a 50% haircut from high to low. So that means, well, we're pretty much due for the water slide now. Whether it kickstarts into the end of this year, meaning next week, or into 2023, let's see what happens. But I'm very receptive to this. Second thing we want to be mindful of is the VIX. So right now the VIX is at about 20. And if we're going to repeat 2008, this is the other indicator we can look to get clarity on where we're going to go. So if S&P is going down and volatility goes up, what does that mean? Well, it means people are not able to predict what is happening here. And I'll give a little bit of a caveat here. This current drop, I think the reason why we haven't backtested the previous top is because it's been talked about, it's been telegraphed, people have positioned. There hasn't been very much surprise. So if we're going to get this huge shot in volatility, there has to be some kind of black swan event, meaning something we did not anticipate, did not price in, and that is happening fast and dramatically. I'm going to ask you one more time, please, and thank you, if you could smash that thumbs up. And if you're wondering what to do with all these notes or how to trade, you can join us or me, Justin from YouTube, and you can get 14 days for free. And our Santa Claus special offers up to 44% off from now until the end of the year. Encourage you to take advantage of that. So if we think about this, if we're not going to, so we're starting 100 years. We talked about the bullish scenario. We have to pretty much remain green on the year, which is the seasonality chart. For the red side, it's only been 1 out of 4 times or 25% of the time. But let's not ignore what could happen. We're aware of 2008. We're aware of what could happen. So if we're going to repeat this, we need to have something that is unexpected. It could be systemic risk. It could be the Fed. It could be the virus. It could be anything. It could be what's happening in Europe and the energy crisis. It could also be what's happening with those other 2 countries. I don't know. I know there's a lot of potential black swan events. By the way, I've laid those out in our group. You can find those at thealgo.com. But I don't know which one is actually going to cause us to go lower. So I'm not in the business of trying to be Nostradamus or predict everything. I'm in the business of trying to react to make money. I'm in the business of making money. That's what I want to do. So we talked about this. We're now going to close it out. What is a bearish engulfing candle? A bearish engulfing pattern is a technical chart pattern that signals lower prices to come. This pattern consists of an up green candlestick followed by a large down or red candlestick that eclipses or engulfs the smaller up candle. The pattern can be important because it shows sellers have overtaken the buyers and are pushing the price more aggressively down. Then buyers were able to push it up. That's all it means. It's just a pattern. It tells us the psychology of what people are thinking. And when the volume bar is bigger and we've engulfed the bar and we're closing out closer to the low, that means it pressures here. So if we're not going to get so if it's going to be green, we know the template now. That's what happened in 1966. That's what happened in 1937. It's what happened in 1890. And now we're looking at the pattern, which is 1973 and 74. If we open up red and we don't really go very green, that's really important. I want to drill down now on this one pattern here, which is going to be the 1973-74. So let's blow it up or zoom it in, and let's see what happens here. So we did hit the 3-bar look back, but then look here. What's really important to me is we're going to snap one more line, and we're looking here to the next candle top. So that's our 3-bar look back. Our 2-bar look back now. Let's make this bar red so it's very obvious. And that is the one time where we didn't actually hold it. Let's make it red, make it nice and clear. So we do not reclaim the previous top here. So even on if it was going to be green, well, that's where we stalled out. It was no higher than the 2-bar look back from the time we started the bear engulf. Okay, cool. Hopefully you guys understand too. If you don't, please make sure to drop me a comment. I would appreciate it. Looking forward to here now. Okay. So now if we look here, that's our 3-bar look back. Our 2-bar look back is here at 3760. So at 3760 or 375 roughly on SPY, that's like the line in the sand. So if we're not going to do the 3-candle look back and we also recoup and hold 3760, let's snap that line on here. Let's use the magnet. So it's the exact number, 3760. There we go. So if we remain above 3760, that means that we're maybe going to repeat that 2008. Sorry, we're going to repeat the green pattern where 3 out of 4 times we've gone higher. That's like really simple. The levels are into 2023 are going to be very easy for me. It does not mean we're going to be able to execute these perfectly. It just means that we have to be receptive to history, 100 years of history, 150 years of history. Do not ignore it, please. So that's it. At a very high level, that's what we're looking for. If you want to follow me on Twitter, again, the link for my profile is in the description in the top comment. We've talked about the bearish engulfing candle. There's very little happening this week for data. We got a holiday on Monday, and then we got initial jobless claims on Thursday. So it's really going to be price action that drives things this week. We're also going to circle back here and have a look at the charts, notably updating SPY, QQQ. And what I want to do is actually update these lines, meaning the green and red for you live. So as we do the weekly videos on every day next week, you're going to understand where's support, on a weekly chart and where resistance is on a weekly chart. And then we're going to look at the daily chart to know how that is forming because, yeah, well, we're now below the green line. So that's like kind of important for us to update and come back and look at. All right. So let's go here to our bear scenario. Our bear scenario was that I just laid everything out, by the way. Encourage you to rewatch it if it's unclear. Goldman's World Outlook through 2075, major themes. I want to focus on this third point here. Let's read them all, but focus on the third point. Slower global potential growth. Okay. Emerging market convergence remains intact. A decade of U.S. exceptionalism unlikely to repeat. Again, it's a decade. What is that? That's a period of stagnation or stagflation. Also, where the U.S. becomes less competitive on the global stage. Less global inequality, more local inequality. So if we go back to our chart now and we look here at SPX, even when we have the green year, we don't really go anywhere for a period of how long? Well, let's look here. We're looking at 1930s to 1940s. That's nothing. Remember, S&P normally returns about 10% per year, but you have to be willing to hodl forever. You got to hodl on. But for 10 years, when you get zero, you get a big donut. Remember, inflation's still about 5 to 10%, somewhere in that range, depending on where you live. Well, you're losing 5% per year in nominal or real terms. So from 1937 to, let's actually look here. So from the bearish engulfing candle high to when we form a new sustained move higher, it's 14 years. Oh, that's like not great. No, that's like not great. If you're looking to go into retirement, maybe you need your money more than in the next 14 years. And you're just going to get your money back. But it's also not going to be worth very much more. So in this period here, we did form a higher high after 6 bars, but it wasn't really sustained. It wasn't an expansion. How long did it take? It took us 14 bars again, 14 years. And if we now look from our 1974 high to when we actually formed a sustained move higher, 7 bars. So again, we're still looking at about 10, which is what? A lost decade, which is what Ray Dalio was talked about. So if we think about that, what if we don't really go anywhere for 10 years, right? We chop around maybe somewhere in here, and then we form that expansion. That's the bear scenario. It doesn't happen frequently. It happened 1 out of 4 times or 25% of the time. But when that bear roars, oh, it hurts, it stings. And because people have not seen this in their most recent history, they kind of don't know what to do through it. They've never experienced it. They've never seen it, which means they probably don't really know what to do. And that's like really important for us. So that's the scenario where this could self-fulfill. In hindsight, you're like, oh my God, how did I not see the writing on the wall? I think there are issues around the world that I don't want to talk about today. Hopefully you're aware of them. Hopefully you're aware of the potential, and we're just going to leave it there. And when we look here too, the losses happening in big tech, I think we also have to look at a heat map because I've been trying to make sense of the decline in tech. And we know that technology, so the saying is that chips lead tech and tech leads SPY. So when tech is leading the losses in 2023, it's like not pretty. It's not pretty at all. However, is this just a tech story? No, it's not. We look here to our heat map year to date. It's red everywhere. The theme is red. If we remove the groups, it becomes more clear on a year-to-date perspective what's doing well. Right, health services, energy, select financials, select health, select non-consumer durables. If we now look at a shorter time frame, like 6 months, well, the red's like all kind of concentrated in tech. So if we now go here to a no group, okay, well, theme is dominantly green, and then big tech is red. Amazon, Apple, Microsoft, Google, Nvidia, Meta, Tesla. That's the theme. Otherwise, over here, the theme is green. Market's healthy. It's big tech. So we really have to pay attention to big tech. And with closing 2 weekly candles below the 50 MA, I'm starting to get more nervous for that drop. Again, same theme here now. 3 months, mostly green, except for Meta, Tesla, Amazon, Apple, Microsoft, Google. Let's look at the last 1 month. Crap. Now the theme's turning more red, where these last soldiers are the ones that were holding up the market for the last couple of years. And now, because of their dominance or heavy weighting or being the biggest blocks, they're hurting. Now, a lot of things are red. This is very mixed. Let's go back here to to sector. So energy's not working. Health technology is working. Consumer non-durables is working. Utilities are working. Everything else isn't really working. If we look here now at a 1 week, it's kind of the same story, right? It's tech. Tech is the soft. Tech is soft. Tech is soft on every time frame year to date now, which is why these losses are getting so dramatic. 800 billion in market cap deleted for Apple, 750 billion deleted for Microsoft, 836 billion for Amazon, 783 billion for Google, 629 billion for Meta. And they don't even include Tesla here because, frankly, it's not really a large cap anymore. It's worth less than 500 billion, sorry, as of December 22nd close. So this is really interesting. But something else which is really interesting here is, again, on our platform, thealgo.com. Again, you can go to thealgo.com to learn about it. 14 days for free on our pro trial. And there's sales on right now. Anyways, let's just give you the meat and the potatoes. So when we look here to, we're going to our unusual option flow for more than 100,000 in premium. We look at month to date, December 1 to 24. We talked about the VIX before. What have they been buying with this VIX down and suppressed? Well, lots of puts, 1.64 put call ratio, 12 million put flow, 7 million call flow. But let's just look at the overview to simplify the story. And we added in a new feature here, which is going to remove SPX and SPY so we can focus on single stocks a lot better. So when we look here, on the right side, Tesla is the most shorted stock, 7.5 billion in premium month to date. In calls, 500 million. That is dramatic. That is hugely bearish. Next one here is going to be Amazon. We look at Amazon. We got Amazon here, 3 billion short, 137 million long. Whoa. All right. After that, we got QQQ. So let's look at QQQ here. We got 3 billion short. We got 500 million long. If we look at Apple, Apple's the one that actually has the best ratio, 900 million short and 200 million long. So that's only about 5-to-1 put call ratio. But these large cap techs, which we already showed you, are like down dramatically year to date, are likely going to be where the pressure is felt. So if we look here to the QQQ chart really fast, what do we know? Well, it's been like a tough year for tech. If we look at a 12-month chart, we're currently down by, we're down by 32% as we sit right here. And we're already below the 2021 low, the 2020 high. This is likely going to want to go lower. It's not a bearish engulfing because the sell-off started in the end of 2021, which is why we have that lower high and lower low, which means the S&P as a whole has been strong. We showed you on the heat map, but technology has been very soft. So on a 12-month chart, there's some warnings here. Forget it's QQQ. Look at the chart. It's flashing a huge warning. Look what happened back here in 1999, 2000. Oh, man, that doesn't look good. If we look at a 1-month chart, it's got a micro higher low, and we're not really finding dip buyers here on the 50 MA like we did before. So it's throttling it. We're set for almost a bearish engulfing candle if we go much more red. And then we look here on a weekly chart, and we're set to close below the 50 monthly, by the way. That'd be the first time. Oh my goodness. That's the first time we get a monthly close below the 50 MA going back to 2008. There's another parallel. All right, cool. Now let's look at a weekly chart. Well, we got 2 weekly closes below the 200 MA, and that doesn't look good. We at least went sideways during that period. So at best, we're looking for sideways. That's what it tells me. We have to form higher highs. We got to get over the 200 weekly to start doing that. 50 weekly, the blue line. So right now, the battle is to the upside. What the bulls have is, like I just showed you, we have to go higher, and then we have to hold. We have to hold the line, right? Got to hold the line. Got to hold the line. Got to hold the line. And if the first quarter is better than expected, maybe we can get higher to hold on. But this is seasonality going back 20 years. So ask yourself, do you want to rely on 20 years worth of history for seasonality? And what's really important here is that we're looking at cyclicality versus seasonality. Cyclicality means a cycle. Seasonality means the time of the year. So we're in a cycle and the season. So the cycle says big down, but the season, again, the time of the year says maybe up or flat. So please be very mindful of that. We can still have the seasonal move within a cycle. Again, cycles happen over a much higher time frame. So just be mindful of that, please. So seasonally for 20 years versus cyclically for 100 or 150 years. There's a little bit of hope here too. Is it going to be false hope? Is it going to be a trap? Are bears trying to realize profit? Let's have a look here. So here we're looking at the CFTC S&P 500 speculative net short positioning, or basically people betting against the S&P 500 through the futures market. And for the first time on December 30th, we actually see it tick back below 160. And that's when we had our low in October. So on October 10th, we had our weekly low, and that's when we hit 160 here in net short. So the last time we went back below that area, we had it in October 14th, and that's when the market went higher. So if we're going to get that seasonal move, like we can't afford to stall out into the first couple of weeks of the year. Yes. If that's going to be the end of the bear market too, we have to see the shorts come off even more. They reloaded every single time. So we have to look like we had here in 2020. where we go down to less than 100,000 contract short and then flip the net long. We have to see this if we're bullish. Otherwise, that dominant big pattern is likely going to materialize. All right, now let's go through and have a look at SPY and QQQ, and then we'll briefly look at the other charts, but we're not going to spend too much time on them. So here we have S&P 500. Look at a few things here. So we're just going to delete and clean it up. First thing is that we have a dominant red downtrend. This downtrend just signifies the trend. The trend is down. If you can't draw trends, it's easier to look here at the 50 MA, which is pretty much acting as that trend line or the red line I just drew. So the dominant trend is red. And now we have three levels. We have red, white, green. Red means resistance, white means important, green means support. If I look here at a monthly chart, you're going to understand where these levels come from better. So the red line, well, that's like all of that's where there's all this congestion going back to the February low, the April low. We got our real bodies here in the monthly and pretty much where we stalled out. That's like a perfect pattern. Yep. So that's where it comes from. And then our green line comes from our May low, 380.54. All right. So if we understand that, looking back at the weekly, that's what's driving this. It's those areas. But now support is no longer found here on the green line because we penetrated it. So where is support now found? Well, let's use our magnet and let's now move this line to where we need to snap it. So oops, let me turn it back to green. There we go. Turn it back to green. Let's use our tool here, our crosshair. Let's move it. I would probably say here at 371. We can even really go back here to about 370. Let's just do that. That's probably strong support here. We do have an inverse head and shoulders here too. So do we want to just move it down to here? Yeah, I'd probably just say 362. So actually, because we're going to do weekly videos, I'll put it back here at 371. There we go, 371. So now this green line is no longer support. It's going to be important or a pivot. So there we go, updated to white. We still have our white line here, which is also important. But now I'm actually going to delete this red line because we're not going to make it back up to here. We got to form a weekly higher high. We'll readjust it if we need to. So this white line now is going to turn into red, which is resistance, because if we poke over it at basically 390, it means we're forming a weekly higher high, which means that we're at least not repeating 2008 immediately where we go straight down. That's it. That's the chart. It's finished. There's no more work to do. All the dominant volume is red, so our red downtrend is also dominant. It confirms it. Price action confirmed with volume. Cool. Let's see what happens next week. Also, a really important area is going to be 381, which was our failed weekly breakdown. We talked about that. And just to touch on it briefly, the failed weekly breakdown, I think, happened because we saw those net speculators take off some of their short positioning, which means as we went lower, they covered. That's how we got back up. It's that simple. All right, there's our QQQ chart. And remember, for every next day next week, we're going to look at the weekly, but we're going to drill down to the daily to look at these levels here, like the 50 MA, the 200 MA. So we're not going to spend too much time on that today. But now you understand where the levels come from. QQQ, all right, same thing. Red line is pointing down. That's all we got to look at. Let's update these lines now. So let's use the crosshair. Let's grab the magnet, and let's see what's actually happening here. Well, we blew out our 200 MA. So we blew that out, and we're closing below it twice. It's the black line. You see it right here, 2 candles below. We had the potential for an inverse head and shoulders. We lost that by poking and closing below our low at 269. Again, a little bit more evident here on the monthly chart where it comes from. There's your white line, which is going to be the May low. And then we got our green line here, which is the June low. Going back to the weekly, now we got to update these. So one more thing I forgot to note here is if we look on the monthly chart, if you look at where this red line goes to, it pretty much goes back to where we are right here. And the green one goes back to the lows. So we're looking back to the summer of 2020, where this forms a massive head and shoulders inside of a downtrend. And I don't like to always talk about this because I like keeping my charts nice and clean. Naked charting is what I like to call it. But that's just what we have to pay attention to. So is green now support? Well, not really. We have to go lower. So I would say this line needs to move down here to probably our low here in October. Why? Well, our low for November 7th is 263. We printed 262. So we've already violated that area too. That's not support anymore. All right, now we need to move these white lines. So let's move this white line from May here to the June. That's now going to be a pivot. And then the red line, that white line can be deleted. The red line's now going to move to our May low. Why? The May low here at 280.21 is also going to roughly track our 200 MA right now at 279.3. It would also be a weekly higher high. So if we get above the red line, we're not changing the trend, by the way. We're just getting over resistance. For a weekly time frame, red is resistance, white is important, Green is support. It's that simple. Those are the levels. Let's look at the volume now. Oh, it's all red. So there you go. It's all red. Looking here at DXY, we're going to zoom out for a moment, look at the monthly chart. Where do these lines come from? All right, so green comes from previous resistance, which turned into support if it holds. We can understand that. Let's look, and this is a multi-decade pattern. Why? It goes all the way back to the 1980s. 1980s, formed a head and shoulders. We invalidated by breaching. Again, we just showed you the comparison, 1970s, 1930s. Yay. All right, looking here to our weekly chart now, we should be able to understand what's going on here on DXY. That's where the green line comes from. Let's zoom in a little bit further. So the red line now, that signifies an invalidation of a short-term weekly head and shoulders. So if we poke over there, it's like a lot higher, but that's where, for me, we're going to get a fresh wave higher, over 110 on Dixie or DXY. I'm looking here to the white line. White line now comes from where we're finding resistance. It's also where we tried to initially bounce. And this is going to act as short-term resistance or potentially a secondary head and shoulders that we're trying to bounce off of. So we note that we hit the green line, we bounced off, hit the white line, rejected, and now we're consolidating. So until we get above the white line or below the green line, that's the issue. And now if we look at the trend, it's up. The dominant trend in this time frame is up. So DXY is bullish, which is what we don't want to see if we're bull on stocks. If we're bearish, we love seeing this. Looking here at the VIX now, we note that the trend is not clear because it's actually violating this uptrend here, even though that is the trend I see. I largely just see consolidation going sideways for about 2 years now. We can look at the resistance line. It's going to be going back to 2018. And this just means the market is, again, able to predict and bake in all of the price action and stuff it sees. So I see us primarily stuck. We should probably snap in let's actually adjust these lines here because I think we need to do an adjustment. So we're going to move the green line down here to 18.2, which is going to be the gap zone that we have here going back to 2020. And now we're going to adjust this green line to be white or important because it's 22. It's 10% above 20. It's the gap zone where we started that unbelievable move higher. This was the black swan in 2020. There you go. At a very high level, that's what I want to go through. And now we're going to look at a couple final charts just to see, because the market is more than just SPY or tech. And we noted on the heat map that should have given you a lot of feedback that we're seeing bullishness around the rest of the market. The Dow failed weekly breakdown. It's over the 50 EMA. IWM failed weekly breakdown. RSP failed weekly breakdown. Bounced off the green line. NYA failed weekly breakdown. There you go. XLK failed. That's the spider managed tech sector. Technology. Tech sucks. ARK plunged 7%. 5-year low. XLV failed weekly breakdown. Check. So ARK is confirming the story of tech, by the way. And then financials failed weekly breakdown. XLE failed weekly breakdown. Almost a bullish engulfing. That's it. So let's go back to SPY and see if we understand now. So S&P is closing out basically flat on the week. And it's because of tech. Tech really weighed it down. So thank you so much for tuning in. This video should act as a template for us going forward. And if you enjoyed the content, if you could please smash that thumbs up, I would greatly appreciate it. And if not, please make sure to join us at thealgo.com for 14 free days where you can see how we turn this video into actionable entries and exits. And if not, I wish you a very happy holidays, and I look forward to seeing you on Tuesday. Thank you for tuning in.